right, earnings season giving the markets a much-needed boost. Joining us now is Michael Tyler, Chief Investment Officer at Eastern Bank Wealth Management, and here on set, Rob Croce, Senior Portfolio Manager at Mellon. I don't know if it was much needed, Michael. What you point out, we're only 2% below the highs at this point. But I want to start talking to Rob for a second. I like what you do. You're in charge of risk parity and managed futures, which means you can talk stocks and bonds, but no problem. Fixed income, talk about. So address this, riddle me this. So earlier we were talking about the idea that this is unprecedented to see all these negative yields around the world and central bank sort of inserting themselves into the financial markets. You say you're still comfortable with fixed income to some extent, and that the doves are firmly in charge. Did central bankers put us here, or did the economy of the globe put us where we are right now? Are they manipulated down here, and it's central bankers' fault, and they're going to cause this horrible whatever comes out of this, or should we be here and it's all natural?
Central bankers were responding to the environment, but they also have a new set of tools that they didn't have 20 years ago.
So we invented QE to deal with these types of things, or
I mean,
balance sheets? Or?
It's definitely a new tool. It's another tool in the toolbox. I don't think it's crazy if you really want to smooth out the business cycle. I think there's a valid question about how smooth the business cycle should really be. There's a cycle of sort of burning things down and building them back up that doesn't happen in this kind of world. But the punchline is that if stocks goes down 10%, monetary policy expectations in this country will change, and that means that bonds will do well. So there's room to have a diversification on top of your risk.
I'm just wondering, you say it's a tool. Yeah, CDOs were tools. All those credit-backed instruments were tools back in 2004 and 2005. They were also weapons of mass destruction. Did the tools the central bankers have used, those are not going to, we're not going to look back in hindsight and say, what the hell were we thinking? These were weapons of mass destruction or not?
Any tool can be misused.
Have they misused QE yet?
I don't think we know the answer. For sure in this country, we have had a smoother business cycle than we would have had in the absence of the extraordinary monetary policy.
But is it paying it forward, and is it just kicking the can down the road to where there's a day of reckoning, or not?
For sure, we're going to learn things. I mean, in some sense, this has been experimental. But, if the goal is really to push growth to trend, and we think growth is 2%, trend is 2% now, then maybe we get there. But, 2% seems low.
Well, it's tough to get there with the globe. Michael, that's the latest word. Where did I see it? I saw a headline somewhere that this is going to be one of the slowest years for global growth in a while. It's tough to debate. We might be the best house in the neighborhood, not including China, but it's tough for us to grow here if the rest of the globe is that slow.
Well, I don't think that's really a huge issue. The U.S. economy is much more of a closed economy than people think. I mean, we're talking about trade all the time, and especially with China and so on. But as a percent of our economy, trade is smaller for us than it is for most other developed nations. And so I think we actually do have the resilience here to continue growing, and nicely, 2% plus, even if the rest of the world is slowing down. So that's not my biggest concern.
That would be nice.
I think.
You don't like fixed income either, unlike Rob, do you?
Well, I think bond prices are historically high, and it is supported entirely by the central banks. If we suddenly see the central banks changing their policies about QE in Europe or about interest rates, you could see a really big sell-off in the bond market. Now, I don't think that's going to happen. I think he's right in saying that the doves are firmly in charge right now. But it's a risk. Bonds are expensive. They're not going to get cheap soon, but they are expensive. And by contrast, they're making stocks look a lot cheaper than they are right now. So I think the returns over the next year or so are going to be muted. Positive, but kind of muted.
What do you think, Rob? I mean, I think, Michael, but as a result, you like governments, right? You're not moving out to corporates or other areas for credit, are you, Michael?
No, we went the other way. We decided that as spreads tightened up this year, especially through the summer, you weren't getting paid to take risk with corporates when governments yielded close to 1%, 1% less than governments. That wasn't worth it. So here we now are saying, you know what? You're not getting paid to take corporate bond risk. Stick with governments. At least there, you're doing fine.